Hey everyone. Hello. Hope everyone is doing well. We got the holidays upon us, Christmas and Hanukkah tomorrow. How auspicious and special is that? I hope you'll find time to celebrate, enjoy it with your loved ones. I'll be heading upstate. We have some surprise snow here. So we're going to be delayed by a day, and two of our kids are sick also. So we're going to make the best of it here. Well, what I want to talk about here are our stock picks for next year. I'm also going to do a quick review of the picks we did last year. So that's one. And then I'll cycle through our picks, and we're going to have a PDF drop. If you're on the Lumida Ledger newsletter, you'll get an email sometime tomorrow with our picks. I think the seasonality is pretty good. Some good entries now. I figured why not front load the release of these ideas? So let's start with how we did. I'm going to share my screen. So last year we picked 10 stocks. The S&P is up about 25% year to date, give or take. And here we go. So the Lumida average stock pick returned about 38% in the last year versus 25 for the S&P. Obviously, that's beating QQQ. That's across 10 stocks. 80% of them, 4, 5, 6, 7, 70% of them made money. Last Friday was 80%. It's because one went in the red. And by the way, these are down like 2% in the last week or so. So, if you have a concentrated portfolio like that, you can get more volatility. So by the end of the week, I think they'll be even higher. The point of this portfolio, by the way, was to demonstrate that non-consensus investing works. What I did not include in this portfolio were names we owned this year. We owned NVIDIA, Meta, and Google. Still like them. Owned them Jan 1. At that point in time, we also owned ETHE, for example, which we had sold in May. That was a home run. So didn't include those Mag 7 names because there's a lot of misperception around, I think, how you invest and what does good investing look like. So I wanted to make it more challenging for me last year. I was like, all right, I'm not going to allow myself to own. Actually, I did put Google in this one, but I didn't put NVIDIA, Meta, Amazon, or anything like that to make it a little more challenging. Looking back, I'm like, why the hell did I do that? Life is hard. Why don't you make life a little easy for yourself, right? So, but anyway, no, we're really proud of what we did. The other thing I would say is some of the best performers this year were names that presented themselves as the year went along. So Brad Jacobs, QXO is one. We identified that opportunity in mid-June, went after that, and then we got out, a couple months later, like late September, October. So that was one. And App 11 was another one. We got in that around July, I want to say, when the Ford PE was 13 times. That went up a couple 100% since then, by the way. What else did we do? Dave, obviously. Dave was a home run. We made that pick in January. That's done very well for us too. None of them were consensus picks. None of those names were consensus picks. Most people still don't even know those names are today. So, it just shows the power of non-consensus investing. And if you look at this list from last year, most of these, in fact, were value picks, right? There's this perception that you only make money on growth. It's so not true. It's just lack of critical thinking. You have to pick well. You have to avoid value traps. You have to find companies that are growing earnings. Ideally, they've got free cash flow, they've got buybacks and a low multiple, and that tail of earnings will be secure. Okay, so you have to pick well, of course, right? You don't want to own Walgreens, for example, right? And ideally, you find good themes. So what did we pick? We had our biggest winner was APEI, American Public Education. By the way, the 4Ps like 13 times earnings, and it went up 152% in a year. They teach nurses how to nurse. Nice secular trend. And they have an online education format, so it's low OPEX and low CAPEX. It's capital efficient. Build-A-Bear was another one. Build-A-Bear is hilarious, I think. I love telling people Build-A-Bear went up 100%. That's better than most Mag 7 names, by the way, both of those two. Build-A-Bear and it's like a retailer that sells stuffed animals customized. Last year, the PE ratio was something like 6 times. Now it's like, I guess, 10. So, I mean, let me show you Build-A-Bear. So, these are ideas that would never get through in investment committee, right? Because investment committee, you've got to look respectable. Build-A-Bear up almost 5% today is still going strong, right? So that's the point of a non-consensus investment. And that's why these things are mispriced, because a consensus investment, something that you can be proud of telling everyone in the investment committee and sound smart for picking, will be efficiently priced, or worst, will be overpriced. Right? No one got fired for buying IBM, for example. So that's where the power of non-consensus investing comes from. And when other people pick up on your idea and your thesis, then it goes from under-owned to owned, and then hopefully one day over-owned, and then one day you can sell it. So non-consensus works. Growth investing works too, by the way. Growth also does work. I let myself pick one growth stock in this portfolio, and it's Palo Alto Networks, PANW, cybersecurity play. Okay, so the reason we pick that across all the other cybersecurity names, it has a platform play. It's done well. It's done well. So you can make money on value and growth, and it's a much deeper topic on how you approach both of these and the strategies to take. But the main headline, though, is that you can make money with value stocks. You can make money with non-consensus investing. I just showed you. If you look at a distribution of returns of active mutual fund managers or hedge fund managers, this would be top decile performance. Be like top 5%. I mean, they usually don't break it out after top 10%. They just stop refining it at that level. So it can work. Absolutely can work. We did that the year before last year, and knock on wood, hopefully we'll do it again this year. So what else is worth calling out on that list? Oh, what didn't work? This is what kills me, by the way. This is the thing that really bothers the shit out of me. Is my last pick on this list was, this is my biggest loser, was Avis Budget Group. By the way, we were in that for maybe like 2 weeks, and we got out of that. So that was my last pick of the year. I remember when I had that idea. I'm always looking for ideas. And then I think it was like even like New Year's Eve or something. Like kids were in bed, scrolling through a few things. I look at the price to free cash flow. I look at the technicals. I'm like, oh, this is a no-brainer. And I put that on the list last minute. It was a bad decision. I mean, I missed the obvious, which is that people using Uber and Lyft when they get to the airport and they go somewhere. And like that was sloppy. I'm really annoyed by that pick, because 2 weeks later we found Dave. If I had put Dave on this list, would have been nuts. So, but that's the other part, though, is like when you make a mistake, you just cut your losers and move on quickly. You don't need to hold positions that are losing. Invest in things that work. We've made money on positions like CVS, even though they're down from when we first called them, for example. So, you can do that with active management. Same thing with like Hershey's too, actually. So what else? Kameko, like we're no longer in Kameko. We liked it in the Q1 of last year. It's actually lagged the S&P, but we don't own Kameko. I won't go through all the reasons why and wherefore. If you have questions, you can ask me around that. But just sharing the thought process, right? Google, we did very well with. Google, when they had the kind of the death of by OpenAI in February, we loaded up heavily on Google, and we did it again. I want to say like a month or so ago. So that's been great. I think Google will continue to do well next year too. So let's get on to picks for this year. I'm going to give you bonus picks as well, by the way. Okay. So instead of 10, I'll give you 15. And the reason why is, one of my main learnings this year is, as I evolve and test, my investment philosophy, is that you actually want more exposure to right-tailed opportunities. If I had a gun to head and I could only pick 10 names, we would never have owned those winners like AppLovin, Dave, and QXO. So the idea of concentration is the way you create wealth. It's a flawed idea, actually. What you want to do is, if you've got skill and you've got an edge and you can pick an idea and pick a theme and get a good entry and exit, you want to apply that all day long and then cut your losers. That'll work. And if you look at what Citadel does, Millennium does, look at Point72's 13F, they essentially have an equal weight portfolio across a broad range of ideas, because at any given time, there are actually many decent ideas that are workable. I could tell you an idea right now that's on my list, and I would say, yeah, that's actually a pretty good idea, but I don't own it because the cost of coverage in terms of the time and attention it takes and to really understand is too high. You're constrained by your time and labor. AI can change all of that, of course. So as we get more AI, more tooling invest in our team, the set of securities that we'll invest in will broaden out. And that lets me get more right-tailed opportunities. And VCs know this, right? VC knows that if you invest in 100 startups, 2 or 3 are the fund returners. And you don't know which one it is at the beginning. That doesn't mean invest in every single stock that comes on your desk. You have to filter. You've got to say no to a lot. But if they meet your criteria, then pull the trigger. And generally, an equal weight approach works pretty well because that'll actually check your own biases, right? So, and that's what the best investors in the world do, which are the funds I just named: Point72, Citadel, Millennium, Two Sigma. So open your portfolio up to right-tailed opportunities is one of the messages I want to share today. And we're incorporating that in our approach. You know, if you're taking concentration risk, you're taking on risks that, like when this shooter shot the CEO of United Health, you wake up one day and your portfolio's down a lot due to this random act of violence. Did you pick a bad stock? No, it's just a random things happen in the world. You want to diversify as much randomness away as you can and cultivate your edge. That means applying your edge as much as you can. All right, let's get into it. So I'm actually going to share my AI tool as we go through this. I'll put up a landing page to let people fill out when they want to get access to our AI tool. We haven't built that page yet. We're executing, getting stuff done, but it is pretty darn cool. So our first pick, this is a high risk, high reward opportunity. It's a small cap. And this, I'll pull up on the screen right now. This is called Biote. Biote. It's a hormone optimization and therapeutic wellness focused small cap. So these guys make money. That's good. All right. If you want to make money investing, then invest in businesses that make money. Wild idea, right? Turns out that actually works. So they have a number of locations around the US, and they teach clinicians and physicians on how to provide hormone therapies, which is a growing field, it's like an emerging trend. So they're generating free cash flow, they're generating earnings. The forward PE is attractive. So there's room for multiple expansion. We like that, right? If I can find multiple expansion and earnings growth together, that's good. The entry, by the way, is pretty good. So the forward PE 7.3 times, the trailing PE is 28. This is a 213 market cap stock, by the way. So this is it's a young company. So higher volatility will be in this name, not unlike names like Build-A-Bear, like from last year and all the rest. Small cap, less coverage. Let's start off with non-consensus, right? So there's a non-consensus idea. All right, here's another one. On the topic of healthcare, I did a post last night about talking about the healthcare category. We think the correction is over. These are great businesses. There will still be some overhangs, but if you're looking forward 1 year, those overhangs should clear and you should get clarity, and these things should price more normally. So our pick in healthcare, first off, there are a lot of great businesses in healthcare, a lot of quality businesses in healthcare. In my personal portfolio, I own all the names I'm going to share with you today, but we also own other names too. But it's a top 10 list. So what are you going to do? I think Merck is very good. Merck is a leading pharmaceutical company, been around for decades. The valuation is very attractive. It sold off on all sorts of news, somewhere related to the healthcare industry. What will RFK Jr. do with the Department of Health? What does this mean for vaccines? What will the FDA policy look like? So a lot of that uncertainty has weighed on the stock, and I believe it's priced into the stock. The reason why I like Merck is they're a leader in oncology, cancer therapies, and they've got about 20 different treatments that are in phase 3, not phase 2, phase 3. So that positions them well. And unfortunately, the trend of cancer is a trend that doesn't look like it's going to end anytime soon. So Merck's in a leadership position. They're also very good with M&A, and they can acquire companies on the cheap and do well with that. They're very disciplined about how they approach that. So I think Merck in a year can do well, maybe 20% plus. It's really hard to gauge these returns, by the way. That's another thing. I think these price targets are kind of silly. What I can say is that I think the reward is in excess of the risk and in a material way, where I want the reward versus the risk. So again, there are other things I like in this category too. ResMed didn't make the list. That's a sleep apnea medical device company, ticker RMD. Not a bad idea. Medical devices, they're not going to have much risk from all this turmoil around the insurance category. So sleep apnea is a trend that's not stopping anytime soon. People are health and wellness focused. The number one thing I focus on at night is ensuring I get a good night's sleep. I got a Sleep 8 mattress for Black Friday. I love it. It's so cool. It's awesome. Loves up my sleep just a little bit more every day. But there are a number of good plays in the healthcare category. So the other thing I'll share with you is that the picks I'll share are diversified across categories. So diversification across themes and sectors does work, right? Because one will be working when the other one's not working. So that is helpful. Here's another one, continuing on the theme of non-consensus ideas. This is Bumble. Okay, so Bumble is an online dating app. They're the number 2 player after Match. And Bumble, here's what we like about it. One is the forward PE is 5.6 times. This is dirt cheap. Okay. It was even cheaper before, by the way. Check that out. We've owned this now for a few months, by the way. We're up 20% on it ish. And what I like about Bumble is they're taking all their free cash flow and they're buying back their stock. Their buyback yield is 37%. I think the buyback yield that's sustainable for Bumble is closer to 20-25%. That's fine. I'll take that though. So, if the denominator is shrinking, the share count is shrinking, and so long as the earnings are intact and the revenue growth is there, doesn't need a lot of revenue growth. You see some revenue growth. Can they cover the cost of inflation? Then this kind of idea, I expect, will do well. I don't see new entrants into the online dating space. It's a hated category. So if you take a look at the analyst consensus estimates for the years ahead, they expect revenue growth that is really mediocre, right? 1.7% next year, then a drop the year after, then 4%. It's mediocre expectation. That's why the stock is cheap, by the way. That's also a sign that a lot of bad news is priced in. And it's gone up, 30% in the last 3 months. So this has a low bar to cross. It can surprise on the upside. But the free cash flow buybacks and low multiple is one of my favorite combinations to look for in concert with checking against these criteria. I don't want to do that the value trap. So I don't think Bumble's going to go away. Match is interesting too, but their buyback rate is lower. They're changing their management team every year or so. It's an interesting idea as well, actually. But Bumble, I get a higher buyback rate. So I like that idea. Maybe you own both, or maybe 2/3 weight to Bumble, but I think they're both interesting ideas. So fun fact about Bumble, actually, we owned Bumble in February of last year. We made a call on Bumble and it didn't work. So we sold out of it within weeks. You know, it was down 7%. Like, okay, we're out. Let's just go somewhere else, right? But we stayed on it. And back then, the buyback yield was 10%. I said, oh, it's a great deal. Now it's 25. I'm pretty sure that's it. I don't think 25% is pretty substantial, right? I mean, that's even 10% is significant. But I think the sellers have washed out now. So that's a good example of not buying the dip on the way down and then waiting for it to turn around. Like, you know, just you get out, you go in the timeout zone for a month, 3 months, 6 months, reassess, revisit, see if your thesis has changed, learn more about the category, and in this case, we said, yeah, this is worth getting involved with. Right? That doesn't always happen, by the way, but in this case, it did. So we like Bumble. We're happy with Bumble. Bumble's outperforming the S&P since we bought it, so we like that. All right, here's another one. This is in the boomer theme and trade. Maybe the boomers should get on Bumble, right? That's how you reinvigorate growth. Bumble's focused on empowering women. Well, what if they just focused on empowering older women? That's a growth strategy. We should tell Bumble. We should tell the Bumble CEO, go after senior citizens. Okay, so you go to take a look at this. Jackson Financial is a name we've owned for a while. We've talked about previously, if you've been following us. This is a spin out of Prudential. Okay, and the forward PE is 4.4. By the way, the funny thing about this stock, the forward PE used to be like 2 times. What kind of insanity is that? But here's what I like about it. It's not enough to be cheap because the reason stocks are cheap. And usually they're good reasons, like Walgreens, right? Of course, having said that, Walgreens probably rips next year, right? But so take a look at Jackson. What we like about it is, once again, buybacks, 6.27%. And they take the free cash flow divided by the market cap, you get a 90% yield. That's compelling. That's compelling. That means those buybacks are sustainable and they can increase the buybacks if they want. So this whole category of selling annuities to boomers, I like, because boomers are retiring, and when they retire, their risk aversion increases. They don't want to take market risk. So they want annuities. And there are a number of players doing well in this category. I could tell you 3 of their competitors. In fact, I've owned their competitors. So in this case, I think you could diversify across that basket. It's not about that Jackson itself is special, though I happen to like Jackson for a few reasons above the others, but I think the others are fine too. The category is doing well. So sometimes you have a theme that's doing well. This is a good example. You just don't kind of want to own the theme. Corebridge is another example of that. Lincoln Financial is another example of that. I think Jackson has the edge, but I think the other fine businesses too. So let's keep going. So in the insurance category, I also like Allstate. So Allstate, they provide property and casualty insurance, right? Homeowners insurance, auto insurance. We like insurance businesses, right? It's a classic compounder business. They've got significant earnings growth as well. You can see that based on the difference between the forward P and the trailing PE. And their price free cash flow 6.3 times. That's not bad. They don't have buybacks, but it's a stable, large business, stable brand. If you take a look at the trailing valuation versus history, you can see it's cheaper than it's been in, looking across like 20 years or so. And the states are letting the insurance companies increase prices, pass them on to consumers. So insurance is a category where there are many great ideas, by the way. I just happened to pick this one. Progressive is an interesting idea. Progressive is more expensive, but they're growing more quickly. That's not a bad idea too. So we own multiple insurance companies because I can't say for sure which ones are growing faster than the other. So I want to pick what I think are the best 3 or 4, let them run, and then I can cut my losers and I should do okay, right? It goes back to the idea we talked about earlier. So Allstate is a very neat idea, I believe, as well. Here's another one. Innova we've owned for most of this year, actually, and I've talked about it before. And this fits in the category of non-consensus free cash flow and buybacks. Who's talking about Innova? No one's talking about Innova, right? It's got a forward PE of 9.5. When we bought it, it was around 7 times. So this company makes high interest rate loans for people that are underserved by the banks. They primarily in the US, but they also have some international footprint. They acquired On Deck, and they're headquartered in Chicago. So I think with Trump in office, you're going to have less regulation of high interest rate loan issuers. There could be some risk there, right? In September, Trump said that he'd want to cap credit card interest rates at 10%. Now, this is not a credit card issuer. It's an installment loan provider. I don't think Trump would do that. It's kind of unusual for a Republican Party to even kind of go in that direction, and he hasn't brought it up since then. That's the risk around an idea like this. I think the consumer is strong. That's another reason why I like this idea. You got buybacks 11% too. There's your free cash flow divided by market cap 53%. So I look at that and I say, okay, my base rate return next year is at least 11%. That's better than the S&P average annual return in terms of real terms, right? And in fact, this company over the last 1 year has done 78%, 77% year to date, and the last 3 months, 21%, right? But I think my downside is going to be less limited. So that is an interesting idea. I mean, this whole category of other related themes is good too. Like Synchrony Financial, I think is a really novel idea as well. These guys do the retail private label credit cards. If you go to Macy's, that Macy's card is powered by Synchrony. It's actually, again, it's a bet on the consumer. I think Innova has an edge on Synchrony, but that whole theme I like is the main point there. Here's an interesting data center play. Again, no one's talking about. It's totally in the dumps. This is called First Solar. So First Solar was a hot idea a few years ago. Had a fall from grace. They are a leading solar technology company. They provide photovoltaic energy solutions. Their customers include data centers like Google. So Google has a mandate to be energy independent from the grid by 2030. And they're going to get there come hell or high water. That's going to include nuclear, hopefully, but nuclear will take too much time. So solars are going to be a key part of that. They need solar to power these data centers and to meet their mandates. That's one driver. The other driver is China has a competitive advantage over the United States in solar. There's no doubt about it. They can produce solar far more cheaply than the US can. But Trump has tariffs on China. So that gives First Solar an edge. The risk for First Solar is that Trump or the Republican Party dials back the Inflation Reduction Act and the tax credits for investing in solar. That's the risk. That's why this has sold off in the last several months since July. You could see, by the way, the market was pricing a Trump win, right? If candidate Harris had won or was going to win, this would have been going up because the IRA Act would be intact, right? But I think that bad news is priced in here. I think that bad news is priced in. And it's unlikely that we'll see those credits go away. And if they do, I'm getting a 9.7 times forward PE, right? So, there's some policy risk around this. I think I'm paid enough to own that risk. I don't mind owning that risk. And what else? So this is an interesting idea. If you can study the policy and see where the tea leaves are blowing, you might do very well with it. It's a high ROE business. It is a compounder. They have a dominant market position. I like those qualities about the business. And they have good customer quality. That's important too, right? Tell me the quality of your customers, I'll tell you the quality of your business. All right, so let's take a look at what the AI tool says about First Solar. They've got a backlog of 81 gigawatts. Okay, let's see if we can translate that to dollars. The CEO says demand continues to be robust, technology leadership, profitability boost from tax credits, which we talked about. The bear case, again, is this political uncertainty, IRA Act, competition from international players. That's China. We talked about that. If you look at some of the management quotes, we see compelling interest and commitment from customers, reinforcing our market position. The continuation of Chinese subsidization and dumping practices caused a significant collapse in cell and module pricing. So there's a tariff bet that I'm making here. Okay. So let's keep going. Here's another one. Flex, the old Flextronics. This is a data center adjacent play. It's an interesting idea too. We own Celestica, by the way, which is a similar idea to this. That's already run up. I was kind of agonizing whether to put that on the list here or not. And I think Celestica will continue to run up. But this is still kind of early on its trend development. Okay, so Flex, they provide manufacturing solutions to a variety of different companies, flexible supply and manufacturing system comprising communications, enterprise, and cloud, which includes data, edge, and communication infrastructure. It's a mouthful. Let's take a look at what the AI has to say about Flextronics. So all these data centers getting built is a driver demand for this kind of business. Right. So they have done a focused, a strategic pivot, as I say, towards high margin segments like automotive and cloud. And they have significant share buybacks. My friend, buybacks, right? 10% in buybacks of a decent PE that's well below the S&P 500. So what are some of the highlights from the earnings transcript? We believe power and compute-based revenue will account for 40% of total revenue for Flex by fiscal year 2029. They've done some M&A recently. They acquired a company that provides some data center cooling technology as well. So it's an interesting idea, right? Here's another one, a different category altogether, Abercrombie and Fitch. So A&F, I was actually at the Paramus Mall yesterday. I was meeting a buddy of mine. We get together every 6 months for lunch and dinner, and we talk markets and ideas. He was a Columbia Business School guy and kind of grew up in the Warren Buffett School of Thought and Thinking. And although he also owns, digital assets and some, he has an interesting portfolio. So, but the mall was totally packed. I had to drive around for 20 minutes to get parking. Before you could even get parking, you were in the lanes to access the parking. I'd never seen that before, although I don't really go to the malls that often, but it was packed. They had double the valets just to help with parking. And I did poke around the mall here and there. I mean, it was retail spending will be very strong. The consumer is strong. Okay, that's an N equals one anecdote. We look at Visa spend. The consumer is strong. I generally don't like retailers, by the way. I generally don't like these kinds of businesses because it's hard to find compounders, right? A compounder is a business that can reinvest in itself, take the free cash flow, open up a new location or branch or store, and then generate similar sales as their prior stores and keep doing that again and again and again. And they compound and they grow earnings, right? And so we had a big trend of these quality compounders in retail in the 80s and 90s, like Sears, the Macy's, and the department stores, and Amazon showed up, right? And so, but restaurants, you've seen that quality compounder trend with businesses like Kava, which are pulling back now after hitting like 300 times forward earnings, right? So, but this one I think is mispriced. So A&F is 13.6 forward PE, and the earnings growth is significant. So that combination together, I find interesting, coupled with the fact that they are investing in growth. They are opening up new locations and they're doing international growth. So they're expected to grow revenue 15% next year. That trails off. We'll see. The analysts could be wrong in this assumption of the revenues trailing off, by the way. And then the EPS growth gap, 71%. 60%. If this multiple holds, right? If that trailing PE holds at 15 times and they grow earnings, let's say it's 50%, then one of two things happens. Either the price of stock goes up 50%, or if the multiple doesn't hold, then this multiple compresses to like 7 times earnings. So I like that. Now, what's happening with Abercrombie is that it had a strong run in the recent years. You can see that. And this is like this went from $30 to $100. This is like a 4 times return in the 23 era. So it's been consolidating since then. Okay. You can see the chart now. I lit it up on my screen. It had a monster 2023. It got a lot of hype, a lot of excitement. It was overbought. It's pulled back here, and now it's just consolidating. And this is called it's called a volatility compression pattern. So it's churning out weaker hands, and stronger hands are slowly getting in. So it might keep doing this for a few more months, by the way, right? But the way these things work is I've got to make my stock picks for the next year today, and I can't do it 2 months from now. So I have to share that now. But yeah, I think this is a good one. I think it's asymmetric too. I don't think this breaks below the lower end of $130. I think the upside, could be, 50%, something like that. So we'll see. Here's another one. Different category altogether, international value play. Let's get some diversification to other themes. Banco Macro. This is an Argentinian bank. It's got a 4P of 9.3 as well. So it's cheaper than the American banks, but let me tell you more about this business. I learned about this one, by the way, going through Druckenmiller's 13Fs. He had 2 Argentinian banks. We own them both. So when we looked at the 13Fs, we went through these names and a couple dozen of those names. And we thought, what the hell are these businesses? I remember when Druckenmiller first got involved with Argentina, he just bought the index, right? After Milei and his regulatory reform stepped in, he just bought the index. So he refined his expression. He got smarter. He said, I want to bet on the banks, which makes sense because banks are how you bet on GDP growth and improving economic outcomes. So, and they're great businesses. They're classic compounders. So we looked at this and we said, yeah, this makes a lot of sense. Also, so this business has strong metrics. Here's some of the statistics. Their loan book is growing 25 to 30%, which is growing pretty quick. You don't always want to see fast loan growth at a bank, but they have a leadership position there. They've increased their provision for loan losses too, which is good. So you pair that with the loan growth, and it starts to look more sustainable there. So I think that's a thematic bet. I think you can own other Argentinian banks as well. Now, this name has done 230% in 1 year. Year to date, 247%. The last 3 months, 44%. And the last 1 month, 23%. Okay. That's a value stock. Okay. So let's take a detour for a moment here. What are the hottest growth stocks you can think of? I can give you a few. How about this? MongoDB. All my friends in Silicon Valley, I think they own MongoDB. Take a look. 78 times 4 PE. Not a bad entry here, by the way, but what's your upside? This high valuation acts like a corrosive force on the stock. Because when people make a decision, institutions, they look at that price, they look at the valuation. And if you're not investing in what institutions will invest in, you're going to have limited upside. Because there's no big buyer to sponsor that stock going forward. You could buy a quantum computing stock. That's going to be a 2 to 4 week idea because you're going to be there with the herd. When the herd leaves, there's no institution to carry it, right? So, you take a look at Workday. These are world-class businesses, by the way. They're phenomenal. I've owned these businesses in the past. In 23, we owned these businesses. They were a lot cheaper then. So, you're below February prices, and meanwhile QQQ is at all-time highs. It's a hot business. It's an expensive business, right? And these are more expensive than most of these Mag 7 names. Why would you want to own these? Meanwhile, you've got this Argentinian bank that's up 200%. Okay. Or like I mentioned, Jackson is up like 100%, Innova's up 70%. So why wouldn't you own some of those other ideas, right? So this is Jackson. Yeah, year to date, 75%, 1 year. Now, passes and future returns, that's not my point. My point is that those overlooked value non-consensus names where they have good fundamentals, they can outrun growth stocks that are fully priced or overpriced. That's the point, right? Coming out of a cycle, I'd rather own growth stocks, like coming out of 2023 or even out of 2022. Own growth stocks, best business in the world, and they're cheap. So let's go on to American banks. I like the regional banks. Out of the banking crisis, we picked JP Morgan, UBS. I think you could have bought a number of those big banks and you've done fine. But now we like the regional banks. You're going to get deregulation. You're going to get lower capital requirements. You're going to get more favorable M&A. Consumers aren't going to have the same flight to safety anymore. The consumer is strong. Small businesses are getting more confidence, right? We saw that 3-year peak in small business confidence. They're going to seek loans to expand and invest. Those loans will do well because the economy is doing well. The Fed's cutting rates. So I like Citizens. They've got a presence in the Northeast, headquartered in Massachusetts, but they're building a wealth management business. They've been poaching these advisors from First Republic, which JP Morgan bought. Wealth management is a high quality business. I run a wealth management business. It's a high quality business. That's why we own, CFG, and we own LPLA too. I haven't talked about LPLA in a while. We picked that up in the summer when it was dislocated. But there's, LPLA, we picked it up in like this gray zone here at 215, it's 325. These are recurring revenue businesses and they're quality compounders that can reinvest in themselves and grow. So I like Citizens, good management also. So I think there are a number of great banks actually. There are quite a few good regional banks to own. CFG is somewhat pricier than the other ones. It's one of those you get what you pay for. But I think is a neat idea. I think it'll benefit under a Trump regulatory regime also. Other banks that you might want to take a look at. This is trying to become consensus, especially across hedge funds, is FCNCA. Actually, almost has like an identical chart, right? This is the bank that bought Silicon Valley Bank. Right. Western Alliance, this was in the headlines during the banking crisis. These are interesting ideas. Once again, it's just so highly correlated, right? This is cheaper than the other ones I just showed you too. Axos Bank, this is one of Trump's banks actually, and they're going after niche underserved segments. I think these are all very, very interesting ideas actually. Maybe you just buy the whole basket. That's not a bad way to approach it. So let's shift gears. Energy. So there's some news that came out this morning around the energy category. I'm going to share that with you. Okay. So the headline is Biden may propose sweeping sanctions targeting Russia's energy sector. They're considering the implementation of sweeping sanctions across and against Russia. And what they're going to focus on are these tankers. So what the Biden admin hasn't done is really gone after Russian oil exports. They're, you can't purchase Russian oil if you're part of the sanctions program, but they really haven't limited Russia's ability to export to, say, China or India or Iran. And Russia has these tankers, many of them are unmarked, and they're still selling oil. And the consideration in the Biden admin was, we don't want gas prices to go higher. So they created this segmented market where the price of Russian oil was cheaper than the global market price of oil ex-Russia. So that is changing. They want to give more negotiating leverage, so the article says to the next administration. I guess like a good cop, bad cop thing. I guess Biden's going to be the bad cop on the way out, and then Trump has some leverage around there, something like that. So if those sanctions step in, then the price of oil should go up. So that should benefit energy producers, energy drillers, uh, and it's an event that can change how people think about energy. So global central banks are cutting rates, China's cutting rates, are investing in stimulus. The reason why oil prices are also low on the demand side is because China's on its back, they're on its heels. It's not recovering quick enough. They're doing some monetary policy, but not enough fiscal policy, right? So, those conditions starting to change. My pick here would be Shell. Shell is actually very safe. This is like the most conservative pick in the whole group. I think these are all good picks. That's why I picked them, obviously. But like, there's no reason to own 10-year bonds if you can own Shell. I mean, this thing. Let me show you Shell. All right. There's no reason to own bonds when you can own Shell. With bonds, your upside is capped. You know the upside on a bond. It's going to be the expected coupon. Shell, we've got 8% buybacks. That's more than the yield you get on a 10-year bond by a factor of 2 times. And they're a global leader. They're a large multinational company. They've got capability and resources. They can do M&A. They also have a clean energy play too. And it's very cheap. The price free cash flow is 5.5 times. So energy's been in the dumps generally. It's recovered. It depends on what sector of energy you're talking about. Let me show you XLE. This is actually was doing quite well not too long ago, right? And then in the last, since November 25th, that's been in the dumps, right? So, the question is, there excess oil? If Secretary Bessent wants to keep oil prices low, which is his objective, does that hurt the margins of these businesses? Even if you're encouraging production and you have more favorable regulatory policy to energy companies, well, if you have more energy production, that may not help their margins, right? So the other names in energy that are really smashed, by the way, are these tankers. They've been totally destroyed. So we picked this one up, STNG, a few days ago, actually. These are oil tankers. They've been, again, destroyed because the global demand for energy has been limited. There are a number of these businesses like this, and energy services companies like Tidewater. They've got some insider buying that's taking place. Another one is like Valaris. I could go on. There's others like AS. You can see they're all in the dumps. I mean, a safer way to play this is just wait for this to settle and base. Like this one's starting to base out a little bit. Just wait. Even wait for this one to pull back. But the nature of how these top 10 lists work is that you've got to offer views on the spot. So that's what you got to do, right? I do think that those names will be up, at least in the teens within the next 12 months. They're just hated, they're unloved, they've been dumped out the bathwater, and there are trends that are changing, which we just described. And it's also a good balance against technology, right? So getting names across a couple different sectors, I think is a good idea. I like NVIDIA, Meta, and Google still as well. I shared this post last night on Twitter where, all these Mag 7 companies have like a levered version. So NVIDIA had record assets in the NVIDIA levered ETF, and that's when it started to underperform Tesla. That was a few months ago. Now Tesla has record amount of levered exposure, right? The Tesla's going to lag now. So it's rotate to NVIDIA. That's the move. So I think NVIDIA will do well. I believe that Meta will do well. These names have done extraordinarily well, by the way. Meta is up 71% year to date. I think there's room to grow there also. They're hitting on their ad traction. So they have a leadership position in AI, and that story is still not fully told out there. They've got strong engineering, they've got distribution that OpenAI doesn't have. So, and it's a 25 times forward PE, and it's a lot cheaper than these SaaS companies. So, and Google, Google was on our list last year. It was the only Mag 7 I put on the list last year. Obviously, it's done really well, especially recently with the quantum computing news. And then with the Trump victory, there's less pressure on antitrust. And Waymo, Waymo's in Miami now. They're in Austin now. The leader in autonomous driving, it's not Tesla, it's Google. They've got YouTube. They have an edge in personal assistant AI. They got distribution. They've got the Android platform. There are a lot of ways for Google to win, and it's cheap. And they've got buybacks. So, that seems the cloud business is doing well. Right? I mean, 23 forward PE ratio. I mean, it's pricier than where it used to be. I'm not running out hand over fist trying to buy Google. But we were back here in these green circles are. I'll share my screen. So here at these levels, I mean, you were able to buy Google below 20 times forward earnings. Now it's run up 23 times. And that's the history of Google's trailing valuation. Those were all good buy points. So, you make your money on the buy. Now it's re-rating, it's re-rated. We just hang on to our position and wait, right? All right. So those are our picks for next year. So I give you 15 picks, actually. So we'll look at what happens next year. We'll compare the picks X Mag 7 with Mag 7. In terms of portfolio construction, here's one way to think about it. So one way to approach is to say, look, the Mag 7 weight in the S&P is around 35%. So you could take that 35% and spread it like peanut butter on NVIDIA, Meta, and Google. Okay. And then for the balance, 65%, maybe it's an equal weight across the other names. That's an interesting way to do it. So if you want to risk match or benchmark match the S&P on the Mag 7 exposure, so if Mag 7 really rips next year, then you can say, well, you're indexed to that theme. If it doesn't do well next year, you're not going to lag the S&P on that theme if we picked our ideas in Mag 7 correctly. And I think we did. Let me show you Apple, by the way. Apple is now, once again, more expensive than NVIDIA on a 4 PE basis. So I will be more vocal about Apple once again. Look at this. This is Apple. Apple is almost as expensive as it's ever been before. You're not supposed to own Apple here, people. Is there a bell? Can I find a bell? They don't ring a bell at the top, right? I need to get a bell. Here we go. Okay. That didn't make much of a sound. I tried to create some dramatic effect here, but you get the point, right? Like, what's Apple's earnings growth? Let's take a look at Apple's earnings growth. This is going to lag. These names all rallied Q4 seasonalities, retail, stock buying, same thing with Tesla too. Okay, they're growing earnings. Well, 20% pricing for next year. That's a massive increase from where they've been. That seems to me price for perfection. Did you buy an iPhone this year? Did you get the Siri upgrade? I don't see people doing that. So Buffett's out. Buffett knows one or two things around Apple. So Seagate. So I own Seagate and I sold it. It just wasn't working. This is a Druckenmiller pick too, by the way, but we always do our own independent analysis. The thesis for Seagate is that they're going to benefit from data center trend, right? So data center needs memory, both solid state memory, and it needs, HBM memory. That's the thesis for Seagate. And, people's lives and the documentation and biography will be on these data centers. So maybe that's why Trump wants to annex Greenland. They can put all the data centers there, I guess. So, but it's just not working. That's why I don't own it anymore. I kind of get the thesis, but if it's not working, then I'm not going to be involved again, right? And this is something that this is good hygiene you should be doing. Someone listening to this is not cutting the losers quickly. You know who you are. So, we got in there around the 200-day moving average, didn't work, fell, 7% here. 7% is a good rule of thumb to sell if it's not working. If it's a more volatile idea, you obviously have to adjust that or think about that differently. But maybe it's wrapped up here. There's been this kind of cascade, but even if it recovers, I think this overhead supply, that psychology could prevent this from moving higher. That's hypothesis. Maybe it's overowned. So that's that on Seagate. So anyway, that's to wrap up. Again, so I shared the numbers with you. The top, our stocking stuffer stocks from 2024 up 38% year to date, beating the S&P, which was at 25%. That's like a 14% spread with no NVIDIA, no Meta, no ETH, no Bitcoin, no Dave, no app, and names that people never heard of. Those are non-consensus ideas. So, and 8 out of 10 of those names are value stocks. They were value stocks, right? Just buy good businesses that grow earnings and get it at a good price. And if they can compound, fantastic. Then you should do well. So I hope that helps. Hope that was fun. Make it a great holiday season. I'm looking forward to heading upstate tomorrow. By the way, if you have small kids like I do, I'll give you a quick parenting tip. I have 2 small boys, 6 and 4. My daughter behaves really well. She's 2. I don't have to worry about her. She's amazing. I'll be working for my daughter, I can tell, like in 10 years. But my boys weren't behaving. So I read them the lyrics to Santa Claus is Coming to Town. And it's actually like really terrifying, right? It's like, he knows when you've been good or bad, naughty or nice. He knows when you're sleeping. He's making a list and he checks it twice. If you read that to your kids in a slow, methodical manner, they'll take you more seriously. Then you play the song and you say, look, then they believe what you're saying. So read them Santa Claus Coming to Town. They'll behave for like 30 minutes. Then you give them a hug afterward. All right. So anyway, enjoy the holidays. We got our boys a Nintendo Switch this year. So hopefully introduce them to gaming. I turned out okay. I grew up with a Nintendo and like Duck Hunt and a couple games. So we'll see if that works. All right. Take care. Happy holidays. Thank you, JW, as well. And this will be on a Spotify, Apple. Just look up Lumida non-consensus investing if you want to listen to it on your drive or your plane. It should be there within 24 hours. All right. Take care, folks. Be well. Have a good one.